So in this video clip, we're going to set up a bull spread using call options, set it up in Excel, and we have a combination of a long call with a lower exercise, a short call option with a higher exercise, and then the combination of the two yields this payoff strategy or portfolio strategy, where for a section of an increase, for a section here of this underlying stock price, as we increase, the value of the strategy increases, but then it plateaus. And also here on the downside, we control for risks. We truncate some losses here at the bottom, and so we also plateau. So it is a long position. It's a bull strategy. It's a bull in the sense that we take advantage as the price goes up, but some of the loss here can be hedged and we sacrifice some of the gains on this side here. So to see how this strategy could be set up, we can build. We estimate premium here based on the Black-Scholes model. So to set that up, we can go into Vinegar Hill, go to Black-Scholes, and we have a formula here, a couple of formulas for a call and a put. We can load these in. So we can just copy both the call and the put, and we'll use this Black-Scholes model to estimate the respective premium associated with the long and the short position. Now we can remove this for a moment and go into our developer tab here, and then come down to, it is book one, it is empty, so there should be no other modules there, and we can paste in, and we have the Black-Scholes put and the Black-Scholes call. Let's for the moment just copy the name of the function that will come in handy later on, and we can put below, paste. So we initially, what we want to do is set out a set of variables, the Black-Scholes parameter inputs for the stock price, for the exercise, the risk-free rate, for the volatility of the asset price return, the stock price return, dividend, and the time period, right? And we make that just a little bit bigger. And then because we have two positions, we have a long call. So in the bull spread, we have a long call and a short call. And the long call has the lower exercise. So we'll set out fairly typical values that we've been using all along. Risk-free rate 5%, dividend, volatility 20%, Q is equal to 0, T is equal to 1 year. And if our Black-Scholes call function, Black-Scholes, now we can invoke the Black-Scholes call because this is the user-defined function we loaded in, and then we can very easily load in the arguments. So S is 100, the exercise is 100, the risk-free rate is 5%, the dividend is equal to 20, there is no, so the sigma is equal to 20, no dividend is 0, and the maturity on the option is 1 year. It's European option, and we get our familiar 1045. Now let's set each of the parameter inputs equal to what we observed before, but we might change then the exercise to be a little bit higher. And then if we pull this across, we get 163 for the value of the premium associated with the long call for the short call option. Okay. Okay, so initially here we want to map out the payoff on the long call option. That's fairly simple to do. We can pull down here to 200, right, and make that just a little bit smaller so it comes into our line of vision. And then this is the long call position. And we would say the value of the call is equal to the stock price minus the exercise will lock the cell reference by hitting F4, 0, and then close the brackets, and we can pull that down, drag that down, and then we get that familiar intrinsic value for the option. So if the exercise was equal to 100, then we would get this type of payoff. Now that's just a long call, but what we've neglected to put in here is the premium. And so to get the premium, we would say equal to same, but just subtract away maybe a premium based on the Black-Scholes model. We can F4 and drag that down. The premium will not change once we've paid the premium. It won't change. Now to include that in here, we just select and we can say add, and we can say long call with premium. So PEREM, premium. On the horizontal axis, the stock price or the asset price, and on the vertical axis, then the payoff associated with that. And we can load that in. Now, when we look at that, of course, we can see here that we have some premium, and then the payoff, the intrinsic value of the option, the maximum of S minus X, right? Here below, denoting that we have taken on board the premium. Now let's remove the other one, the first one, and let's go with the short call. That's again, short call position would be equal to a couple of ways we could do this, but we could say maximum. So basically we could say negative maximum, open brackets, maximum, open, S minus the exercise associated with the short call. So that's the 130, and then F4, comma, 0, close brackets, and then subtract away the premium, the 163, will F4 that to lock the cell reference, and then close off the brackets. We get a result. And so when the option, when the stock price is low, we're earning some money from the premium. Let's have a look at that. Let's incorporate it in. Select data, add short call, and then on the horizontal axis, the payoff, so the stock prices, and then on the vertical axis, payoff. Right, we take a look at that. And okay, so we have the long call with the higher premium, the short call with the lower, with the higher exercise, but the premium is much lower. And we can then, just to take the portfolio or combination of two is just equal to both of these together. So that gives us the combination. Adding both together would give us the combination. And then if we want to incorporate that into our diagram, then right click, select data, add, and we can say portfolio or combination, portfolio or combination. And then on the horizontal axis, the stock prices, the range we had set out going from 10 to 200, and then the payoff, which is just the sum of the two. And you can see here then the premium that's associated with that. And we can put in legends, and we can put below, right? Make this a little bit bigger to examine the payoff from this bull spread. Now, it looks like it's a reasonably good representation. We might explore a little bit by putting in a higher level of volatility, and it does differentiate a bit then. So the combination here, the bull spread, if you like, is this combination where you have a long call with a lower exercise, a short call with a higher exercise, and then taking the two together, we can see over a given range, the value of the strategy increases as the stock price goes up, but then we truncate the gains. So the gains are not unbounded, the plateau here. We sacrifice some gains using this strategy to offset the losses down here. So we don't continue to lose as the stock price falls. In that sense, then we've put boundaries on the amount of loss we can incur, but also we're willing to sacrifice some potential profit. This strategy is a useful strategy. The cost of setting it up is relatively small, right? It's just very simply equal to the difference between the two here. So the long call costs a little bit more than the short. This is the cost of setting up, which is $9.72. So it's cheaper than buying just the option on its own. So it's an interesting way to leave a bet and also spare your capital. The gains you have are not unbounded, but at the same time, your losses also are controlled the other side. So it's an interesting strategy. It's a popular one amongst traders. That's a bull spread.